Hello everybody. Today we're going to be going over the Nature Mountain DCF problem. Let's get started. So we start every problem with taking down some of our assumptions that we're going to be making. So let's start reading the problem. This first paragraph just tells us that we're making a new product. And we're going to start here. So a market research study which cost $20,000 to complete, right? So this market research study indicated some values, but this first number we're given is 20,000. Now, this $20,000 is a sunk cost. All that happened with it was that they paid $20,000 and now they know all of this information. However, this $20,000 does not go into their investment decision because it's already been spent. If they decide to go through with this decision, or if they don't decide to go through with this decision, they've already paid the $20,000, and therefore they cannot. This number is pretty much useless to the problem. So now, this research though has indicated that they can sell 100,000 units per year for 5 years. So we're going to write down 100,000, which is our unit sales. Now, of these 100,000 units, the market research says the price will be $5 per unit. All right, $5, and the variable cost will be $2 per unit. So we write down that. However, right, the market research, however, they expect that some of this volume will come from current customers who switch from their existing Nature Mountain products to this one. So there's going to be some cannibalization. In this problem, they call it stealing. Right here, steal impact. However, this is the same as cannibalization and other problems. So essentially, or they also call it erosion. But we're going to be stealing $75,000 every year from some of our other products. So let's go to steal impact. There is no place to put it up here. And we're just going to write negative $75,000 because we're going to lose $75,000 from our other products every year if we create this product. So we're just going to copy that across to every single product. All right, and it remains constant throughout, even if sales grow. The next thing we learn is that in order to do this, the company will need to purchase equipment for $500,000. So we're going to put this. So equipment cost $500,000. There we go. And this is going to have a 5-year life with a straight line depreciation. So, salvage value. So I'm just writing this out. It might be obvious to all of you what this amount is now, but I'm just going to write it out so that it's perfectly clear. So we have an equipment cost of $500,000 with a salvage value of 0. So that means that we have depreciable cost. I can't spell that, but depreciable cost of 500,000 minus 0, which is just 500,000, and then depreciation per year. Will be equal to the 500,000 divided by 5. And we're also going to make this negative. Actually, no, we're not. Sorry. We're just depreciation per year is going to be $100,000. All right. So we just calculated all that out. We're going to need it later. So this is another assumption that we're going to have. So in addition, they will also use some land that they already own. So this land they already own, but there's some land assumptions that they had to make. So they could sell this land for $100,000. So the value of land right? So this is $100,000 that they could get in cash today if they sold the land. However, the land, its book value is $60,000, meaning that the land was originally purchased and made ready for use at around for $60,000. So that's what they have on the book. Remember, land can never be depreciated. So now if they sold the land today, they would get $100,000. They would have a book value of $60,000. So they would make a gain on the sale of the land of $100,000 minus $60,000. They would need to pay taxes on the gain. So taxes equals, taxes. They would need to pay taxes of $40,000 times, we don't have the tax rate yet, so we can't do that yet, but at least we're building it out. So now they also believe they will be able to sell any remaining assets, including the land, at the end of the project for $120,000. All right, that makes sense. We'll just write that down. Ending sale price, $120,000. All right, and then incremental advertising will be $50,000 per year, while total overhead costs will not change for the company. All right, so incremental advertising is going to be a fixed operating expense. Now, let's get into this overhead. So total overhead costs will not change for the company, period, right? This $35,000 a year will be allocated to the company as overhead, but it does not actually cost the company as a whole any money, right? So the total overhead costs are the same, regardless of if they go through with this project or not. However, just on their internal company reports, they will say that $35,000 a year of this overhead will go to this project. So we don't actually include this $35,000 a year because it's not incremental, while this $50,000 a year is incremental. So that's why we only include the $50,000. So next, you will need $25,000 of working capital at the start of the project, and the working capital will be recovered at the end of the project. So we're just going to start off with $25,000 negative at the start of the project, and we get it back at the end of the project. So $25,000 in net working capital $25,000 of cash goes into net working capital in year 0, and then comes out of net working capital in year 5. And then finally, our last two assumptions, we have our cost of capital, or our required rate of return of 15%, and then our tax rate of 35%. And then that's that. We never hear anything about sales growth, so we're just going to assume that it stays constant, and there's no sales growth. So now we can calculate the taxes in this. So we can do the gain times the tax rate, and that's going to be a tax rate of negative. And so gain time. So then we're actually going to get how much actually we don't need to calculate that. Sorry. So now let's get started on our actual income statement here. So first things first, we have our units sold. So we're going to do equals 100,000, hit F4 to make that an absolute reference, adding these dollar signs to it so that this cell is always referenced regardless of if we move it. So there we go. We get 100,000 for each time. So then sales equals the 100,000 units times the $5 per sale, once again using F4. So we'll just calculate that across again. And then we get that cost of sales equals $500,000 or $100,000 100,000 units times $2 per unit. Sorry about that. And we just copy that across again. Now, the gross profit will equal sales minus the cost of sales. And then we'll just copy that all the way across. And we get $300,000 in gross profit per year. Now, we input the steel impact before, so negative 75,000. Now our operating expenses equal the annual fixed operating expenses, and we're going to make that negative up there. So there we go. Now depreciation is going to be equal to negative of this number, which we already calculated. Remember, that's just the 500,000 over 5 years, which is depreciation. Not always, but in this case, since it's we're depreciating it to 0 over 5 years, we get $100,000 in depreciation per year. So our earnings before income tax equals the sum of all of these values, and we can do that because each of these values is positive or negative depending on if they should be or not. Otherwise, if you didn't do positives and negatives, like if this was a positive number and this was a positive, if all three of these were positive numbers, you'd have to do gross profit minus, minus, minus. But I just like to do it this way, and it's probably better if you do as well, since it makes a little more sense. So then income taxes are just going to be that $75,000 times negative tax rate. And once again, hit F4 since tax rate is in a single cell. So that gives us that EBIT minus the income tax will give us our NOPAT, and our NOPAT is 48,750. Now all we do is we add back depreciation, once again hitting F4 to make it an absolute reference. So then all we do is, to get our net operating cash flow, is we just sum our NOPAT with our depreciation, and we get our operating cash flows. Now, let's go back to these opportunity costs and stuff like that. So, we need to, in year one, we need to actually purchase that $500,000 machine. So let's do negative 500,000. So we're going to outflow that $500,000 machine. However, we're going to sell that machine at the end of year 5. So we're going to sell it for an ending price of $120,000. So let's go and do the calculation for that. So the ending sale price is $120,000. And then our book value is now 0 because the book value of the equipment is now 0 because we have depreciated the $500,000 for all 5 years. As you can see here, there's $500,000 that have been depreciated. So the book value of the equipment is 0. However, the book value of the land, right, which we've actually kept, right, because we're selling, I think it shows right here, you'll be able to sell remaining assets, including the land, for $120,000. So we can sell the book value of the land. So we need to include that as well. So we have the ending sale price and the book value of equipment and book value of land. And then actually we're going to copy this over to here and make it a little bigger. And then based on that, we're going to have the gain on sale, right? And the gain on sale is just going to be the ending sale price minus the book value of equipment minus the book value of land. And that's going to give us a gain on sale of $60,000. Then we're going to have taxes on the sale, which are $60,000 times the tax rate, which we're going to make negative, and we're going to get $21,000 as that we're going to have to owe in tax. So we're going to put that here. So the taxes are going to be negative 21,000. Our taxes from the opportunity cost of land are going to be there, which are going to be 14,000. And actually, in this case, they're going to be positive, and I'll talk about that in a second. Hold on. Equals negative, so 14,000, and then the opportunity cost of land equals the 100,000, and that's going to be negative 100,000. So the reason for this is that we are foregoing $100,000 in taxes if we take this opportunity, and because of that, so we're losing out on a $100,000 cash flow. But that $100,000 cash flow would not be fully ours because we'd have to owe $14,000 on that $100,000 that we made. So because of that, we just reverse it by $14,000 for the taxes that we would have to owe. Now, and so that's why it's negative in this case, is because we're giving up the ability to get that $100,000. Now, asset purchases and dispositions are so we're just going to take the two. That's going to equal the ending sale price. So at the end, we're going to get $120,000 in cash. However, we're only going to, and then we're going to pay $21,000 in taxes on that gain. So one mistake you might make is you might just do the tax rate times the ending sale price. However, that's not correct. You have to go to the gain on the sale. That's why we calculate it, and just take the tax, the 35% of that, to get the amount you owe in taxes, and that not the other way around. So now that we've calculated everything here, and we're just going to sum everything up, and we're going to pull it all the way across. There we go. And then we're going to just multiply by the discount factor. So this one's discount factor is 0, but for this one, it's going to be that's the discount factor. These are automatically calculated for us. So we'll just pull it across, and there we go. Net present value will then equal the sum of all of these numbers, and boom, there we go. 50,717. Negative that amount. So not a positive NPV, and that's kind of a problem, but we'll work on that later. So then our internal rate of return will just be up here, and we get 11.7%. So why do we use the NPV as the sum and not the NPV formula? Well, we can do the NPV formula, and I'll do it right here, and we'll get the same value, but the NPV actually discounts all of these values by the rate. So if we do that, then there would be no point for us to have already discount factored them in here. So because we are using this formula, and because we are then discount factoring them in, or we're getting the present value of the future cash flows in this line, we can just sum all of these. And we don't need to sum these first and then this, because they're all in present value terms. So that's super useful. However, I'm guessing on tests we're not going to be given this, so it's also helpful that you know that the NPV equation just using the free cash flow and not using the free cash flow present values. So that's why we're not using the NPV, because we would be discounting this twice instead of which would not be good because then it would be, much larger discount than we want to give it. And our IRR, we will always use the undiscounted cash flows to calculate IRR. So now our capital expenditure, well, I guess we did that up here. So I should have done this here, but we did not. So now the cash flow for investments. So let's do that right here. So the cash flow of investments. Now I'm kind of forgetting if we include net working capital in investments or not. I just cannot remember at the moment. So let's just do the cash flow. So year zero cash flow for investments is this. And then we're just going to copy this all the way across. And we will get the cash flow for investments is all of these numbers. So how we got this was essentially we're getting the investments that we need to make, or the cash flows that we need to make for these investments. And we're doing it by year. So if we invest in this product, we would need to have spent for the investments $611,000 in year zero, and then we would get back $124,000 in year 5. So this is just the investment, not accounting for any of these growth, these other items on our balance sheet. So the net present value of the investments equals the NPV, and we're going to get our rate, which is 15%. We're going to take all of our values here, and then we're going to add our year zero, and that's going to be our NPV for the investments. Now our equivalent annual annuity. So our equivalent annual annuity is just going to be a payment calculation using our rate. So our rate is our cost of capital. The number of periods, we have 5, and the present value is not that. It is just this, right? So essentially how this is working is we are going to find out how much money we need to make every year in order to be worth our investment. So essentially using the payment, if you remember from like the first half of the semester, you get the rate, you get the number of payments, and you get the present value, and that's going to give you how much you need to make every year in order for it to be worth spending that money today. So the equivalent annual annuity is $163,088 or $163,088 and $880. So we have that, and then we're going to just add back depreciation. So that's going to be depreciation. Boom. Then we're going to get our income tax. But income tax is actually hard to calculate, so we're not going to do that. Instead, what we're going to do is we're going to calculate our earnings before income tax. So we know that our NOPAT is going to be 1 minus the tax rate. So, boom, which is 65%. So we know that this is going to be 65% of our earnings before income tax. So all we're going to do is we're going to do that the EBT equals this amount, or our NOPAT, divided by our divided by 1 minus our income tax rate. So that means that our income tax rate is going to be earnings before income tax, or our income tax is going to be earnings before income tax times the negative income tax, right? And that's going to give us that. So Because of weird rounding, it's not quite right. But essentially, if you took the earnings before income tax, you subtracted income tax, you would get your NOPAT, and this kind of makes sense. So we'll do that. Now our depreciation here is 100,000. So this one actually needs to be negative 100,000. And then our operating expenses, that's just pulled from here. So if you can't tell, we're kind of making a income statement, but we're making it backwards. And so in the end, we get our gross profit that we're going to need of $323,276. So how do we calculate this? Well, or what does this matter, and how do we calculate sales? Well, this is the amount of gross profit that we're going to need every year in order for us to break even on an economic in economic units. So we know that our price of each unit is $5 and the cost of selling each unit is $2. So what we're going to do is we're going to do the gross profit, and then we're going to divide by $5 per unit divided by minus $2 per unit, or 3, to get 107,759 units, which is how many units we're going to need to sell every year to break even. So we're just going to multiply that by 5. We'll go up here actually to do that. And then equals this times 3, or times 2, to give our cost of sales. And then if you add these up, or you subtract cost of goods minus sales, you'll get your gross profit. So this is how you do it, kind of the traditional way. There's another way we can do it, going up here. So let's say we know we want our NPV to be 0. What we're going to just do is we're going to use what if analysis, hit goal seek. That's not the cell we want. We want to set the net present value to a value of 0 by changing this cell, and we're going to hit OK. And we're going to get that same value, and so that's a great way to check your work on these style of problems. So hopefully that was helpful to you all. This is how you do this DCF problem. I was a little tired today, so I kind of rambled more than usual, but hopefully you guys enjoyed, and be sure to comment if anything was a little confusing. And I'll come out with another DCF practice problem walkthrough probably tomorrow or Friday, so be on the lookout for that. So thank you guys for watching, and I'll see you later.